Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Homeownership, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions.
This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
Today, we're discussing the latest findings from the Bank of Montreal's Real Financial Progress Index, which shows a growing number of Canadians are putting home buying plans on hold due to rising economic anxiety and fears of a looming recession.
It's really concerning, Steve, to see that 74% of respondents are worried about a potential recession. That's up significantly from just 60% last month. It seems like people are feeling more uncertain about their financial futures.
Absolutely, Janine. And what's more, half of Canadians now believe homeownership is even less attainable than it was a year ago. This sentiment is largely due to worsening affordability and the stark reality that many are waiting for mortgage rates to drop.
Yes, and it's interesting to note that 38% of potential buyers are holding out for rates at 3% or lower, which is significantly lower than what's currently available. It shows just how much people are hoping for a better financial climate before making such a major commitment.
Robert Kavchich, a senior economist at the Bank of Montreal, mentioned that there's an underlying weakness in the market as inventory builds and investors stay on the sidelines. This lack of confidence is particularly evident in areas like British Columbia and Southern Ontario.
That lack of confidence is reflected in the numbers too. The survey found that 56% of prospective buyers feel they've missed their chance to buy, and a staggering 66% of millennials believe their window to enter the market has closed.
And looking at the timeline, only 14% of those planning to buy expect to do so in 2025, with 24% pushing their plans to 2026 or beyond. It's clear that the perception of affordability is impacting people's decisions in a big way.
The emotional and financial burden is significant. Nearly half of current homeowners, 43% to be exact, say they couldn't have purchased their homes without financial help from family. It's a reminder of how crucial support systems can be in achieving homeownership.
Indeed, and shared ownership is also becoming more popular, with 45% open to buying with non-romantic partners like friends or relatives. It's a creative solution to a challenging problem, though it also indicates the lengths people are willing to go to in order to own a home.
Still, despite these challenges, 59% of Canadians say owning a home remains one of their top life goals. However, 2/3 feel less confident about achieving this goal compared to 5 years ago, especially among younger Canadians who are considering relocating for better affordability.
It's worth noting, too, that 61% of Canadians are content with renting, which is a sentiment more common among boomers and Gen Xers. This shift in mentality might suggest a growing acceptance of renting as a long-term housing solution.
Yes, Steve, and it underscores the importance of flexibility and adaptability in today's housing market. Whether it's considering shared ownership or being open to renting, Canadians are finding ways to navigate these uncertain times.
Today, we're diving into the latest news on Canadian mortgage rates, which are set to rise as Government of Canada bond yields soar on the back of hotter-than-expected inflation data. This development is definitely a concern for anyone looking to secure a mortgage in the near future.
That's right, Steve. It seems like the progress we made earlier this year has been wiped out, and we're now seeing bond yields climb higher than where we started in 2025. It's certainly not the news that potential homebuyers wanted to hear.
Exactly, Janine. The rise in bond yields means that fixed-rate mortgages are likely to see an increase. This is because fixed-rate mortgages move with Government of Canada bond yields of similar lengths. For example, a 5-year fixed-rate mortgage is typically a premium over the 5-year Government of Canada bond yield.
And that's not all, Steve. The inflation data that triggered this surge in bond yields is causing quite a stir. While some might have heard that inflation fell due to the government dropping the consumer carbon tax, the Bank of Canada's preferred core inflation measures actually accelerated. This means the underlying inflation pressures are still very much present.
Absolutely, Janine. The Bank of Canada's rush to cut rates quickly might have been counterproductive, as these core inflation metrics are now above its tolerance range. This could lead to further increases in bond yields if inflation expectations continue to rise.
What's really concerning is that this could make borrowing a lot more expensive for Canadians. With the 5-year Government of Canada bond yield reaching 2.961%, we're looking at potential 5-year fixed mortgage rates between 4.46% and 4.96%, depending on the market and lender.
And while these numbers are still lower than they were at this time last year, they're definitely heading in the wrong direction for those hoping for cheaper mortgage options. It's a reminder of how interconnected our mortgage rates are with global economic trends and government policies.
Indeed, Steve. The scale of government debt relative to the economy also plays a crucial role in this. As borrowing exceeds available capital, yields rise, and lenders add a risk premium to cover costs, which ultimately affects the rates consumers pay.
It's a complex situation, Janine, and one that underscores the importance of staying informed and prepared. Canadians will need to navigate these rising costs carefully, considering all their options in a market that's constantly changing.
Yes, and it's vital for potential home buyers to keep an eye on these developments and consult with their mortgage advisors to find the best possible solutions in these challenging times.
In our final segment today, we're delving into the findings from a recent study by Simon Fraser University that highlights the widening homeownership gap in Canada. The study, led by researcher Yushu Zhu, examined census data from 1986 to 2021 across 5 major cities: Montreal, Toronto, Calgary, Edmonton, and Vancouver.
It's a fascinating study, Steve. The researchers found that while homeownership in Canada improved steadily between 1991 and 2011, that trend has reversed. By 2016 and 2021, ownership rates had dropped, and any gains were increasingly driven by mortgage debt rather than outright ownership.
Exactly, Janine. The probability of an average Canadian household owning a home improved until 2011, but then it started to decline. The likelihood of owning with a mortgage has increased significantly, highlighting a growing reliance on debt to achieve home ownership.
The study points out that this shift coincided with Canada's move towards housing financialization in the 1990s. As federal support for social housing declined, the Canada Mortgage and Housing Corporation was commercialized, and mortgage securitization programs expanded, boosting access to credit. But that hasn't benefited everyone equally.
Right, and it's crucial to note that while mortgage liberalization made ownership more accessible for some, it didn't work equally well for all. Many low-income households, gig workers, and racialized Canadians continue to face barriers in accessing credit or securing a mortgage.
The research also highlights a generational divide in homeownership. While all age groups saw improvements until 2021, those under 45, particularly millennials and Gen Z, have experienced steady declines in ownership rates. Meanwhile, older Canadians are carrying mortgage debt deeper into retirement, which could lead to financial stress as they near retirement.
That's right, Janine. Between 1986 and 2021, the share of 55 to 64-year-old homeowners with a mortgage increased from 24% to 40%. For those aged 65 to 74, that share rose from 10% to 26%, indicating a trend towards larger loans and longer amortization periods for older Canadians.
And while the top 20% income group saw increased home ownership between 2011 and 2016, ownership rates for other income groups stagnated or declined. Interestingly, the lowest income group saw the fastest growth in mortgaged ownership, but they still face significant financial constraints and systemic barriers.
It's a complex issue, Janine, with significant implications for financial planning and policymaking. As housing costs rise faster than incomes for lower-income earners, this gap in homeownership is likely to continue widening unless addressed through thoughtful policy interventions.
Absolutely, Steve. It's a reminder of the importance of equitable access to home ownership and the need for support systems to help those most affected by these challenges.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.